Thank you. Good morning, everyone. Welcome to the Citrin Cooperman Moore Stephens webinar on navigating the new revenue recognition standard for technology companies. My name is Mike Rhodes, and I am an audit partner at Citrin Cooperman, which is a US-based accounting and advisory firm headquartered in New York City. I'm the technology practice leader for the firm and currently work with a number of technology clients on their implementation of the new standards. Moore Stephens is a UK-based accounting and advisory firm with headquarters in London. Citrin Cooperman and Moore Stephens are both independent firms associated with Moore Stephens International Limited, which provides each of us with a global reach through its network of more than 360 independent accounting and consulting firms with nearly 650 offices in over 100 countries. Collectively, we have developed a series of webinars to help business owners understand those accounting and tax matters that are or will impact their business in the US, the UK, and beyond. This webinar is a collaboration between Citrin Cooperman and Moore Stephens and has been born out of the many joint projects our firms work on together. As mentioned, today's program is focused on the new revenue recognition standards as they specifically relate to technology companies. In the US, ASC 606 is effective for fiscal years beginning after December 15, 2017 for public companies and a year later, or December 15, 2018, for non-public companies. Outside the US, IFRS 15 is effective for all companies for fiscal years beginning on or after January 1st, 2018. We're excited about today's program and hope that you obtain some meaningful information as you undertake your own initiative to adopt the new revenue recognition standards. I would like to further mention that in addition to this webinar, we have developed a series of 10-minute webcasts delving into further details of the new standards and providing implementation examples. These podcasts are available on the Moore Stephens and Citrin Cooperman websites. With that, I would like to take a moment to introduce my two esteemed colleagues who you will be hearing from throughout this program. Mark Ayers is a partner at Moore Stephens and leads the technology sector at that firm. His client portfolio ranges from tech startups to listed international groups. He has extensive experience in both UK and international reporting standards and how they impact global operations, specializing in inward investment to the UK. Mark Fagan is the managing partner of Citrin Cooperman's Norwalk, Connecticut office. He is also the leader of the firm's revenue recognition team, the International Strategy Group, and serves as a member of the firm's executive committee and audit and attest committee. What I thought I'd do now is briefly go over our course objectives for the next hour. First of all, what we'd like to do is introduce the new revenue recognition accounting standards to all of you, and then describe how these standards will actually impact technology companies. Ultimately, we'd like to address all the differences and similarities between the US GAAP and IFRS standards. And finally, we'd like to close out by providing you insight as to how you can get your implementation project started. The US and Accounting Standards Boards jointly developed a 5-step model for recognizing revenue under the core principles of ASC 606 and IFRS 15. What you see here right now is basically those 5 steps, which we're going to go into in much further detail. But in essence, this is the model that companies must follow to properly recognize revenue under the new standards. You start with identifying the contract with the customer. You identify the performance obligations under those contracts. You determine the transaction price, and then you allocate the transaction price to each of the performance obligations. And ultimately, revenue is recognized as each of those performance obligations is satisfied. With that, I introduce you to Mark Ayers, who will start the discussion on the actual steps toward implementation.
Thanks, Mike. As Mike's mentioned, we're now starting running through the 5 steps, and I will kick off with step 1, which is identifying the contract with the customer. So it's important to not think about IFRS 15 and 606 as just impacting revenue, but it's a standard that models your business. You should take a fresh look at the business you operate and start from basic principles and consider the detail of the contracts you offer your customers. You might take the approach of considering your business from a customer's point of view. What is it I do and how do I do it? This will help you assess the impact on your organization. In the software industry, there is generally a wider range of contract forms than more traditional industries. Forms such as signed contracts and purchase orders are generally in digital form. It's worth considering again the core principles of the standard, which is a company should recognize revenue to depict the transfer of promised goods or services to the customer in an amount that reflects the consideration to which the company expects to be entitled in exchange for those goods or services. So that's a real mouthful of a sentence, but the key words to focus on are promised and expects. If you generally provide an additional service on other products and the contract in question is silent on not providing this service, it could be taken as an unwritten promise to provide this service. The expectations of the customer will be a continuing theme throughout the rest of this webinar, and it's important that it is not ignored. Now let's move on to look at the various elements of a contract. A contractual arrangement with a customer exists only when all of the following 5 criteria are met. Firstly, it's approved by committed parties. Each party's rights are identified. Thirdly, payment terms have been agreed. Has the contract got commercial substance? And finally, collection must be probable. It goes without saying you must of course identify all contracts. It might be necessary to combine multiple contracts entered into around the same time and treat them as a single contract. This is also in place to prevent manipulation of revenue recognition by breaking up a large contract into smaller elements. Volume of transactions is a key element impacting the software industry. Remember, when modeling your contracts, a portfolio approach is permitted, as this reasonably reflects the application, and it's great news for companies dealing with high volume, standardized contracts. So moving back to the 5 criteria, let's discuss in greater detail some of the key takeaways. Firstly, starting with the first stage, approval by committed parties. It goes without saying it's essential that you can evidence that a contract exists and the customer has approved the contract. And even more important is evidence that a contract is terminated. This is becoming more and more common in renewal situations, where the renewal is an expectation and the revenue recognition could be triggered earlier than the actual approval of a new contract or the termination of an old one. So another point to cover is a contract must have commercial substance and collectability is probable. As part of identifying the contract, a key point is to assess whether it's probable and you will get paid. If you are unlikely to get paid, then you don't have a contract and cannot recognize revenue. This is separate from determining the price, which Mark Fagan will cover later in stage 3 of this webinar. Here you are looking at the creditworthiness and willingness to pay of the customer. There is, of course, as usual, differing guidance between US GAAP and IFRS as to the definition of probable, with US GAAP applying a 75% to 80% likelihood and IFRS adopting a greater than 50%. A key point is that the assessment of collectability is made after considering price concessions, which are expected to be provided to customers. Price concessions are variable considerations, which I will cover later in step 4, which is allocating the transaction price. Now let's move on to the common area impacting software contracts, which is contract modification. Modification to contract is common practice in the software industry. If you're used to dealing with contract modifications, I suggest you review the standard in detail, as your common sense approach may no longer be appropriate. Key points to consider when assessing whether a contract modification has occurred are: have the terms and conditions of the new contract been negotiated separately from the original? Was there a competitive bid process for the new contract? Do any discounts applied in the new contract impact the original? So a modification can be applied either prospectively or through a cumulative catch-up adjustment. An example contract modification is included in our podcast series, which is available to review after this webinar. So I'll now hand over to Mark Fagan, who will discuss step 2 of the 5-step process.
Thanks, Mark. And yes, now we're going to go through step 2, when the entity must identify all the performance obligations with its customer and then further determine if those obligations are units of accounting. So as Mark Ayers pointed out, one of the core principles of these new standards is to make sure at the inception of the transfer of goods and services to the customer that the entity has considered the entire customer relationship in order to properly allocate the transaction price. Now, in the prior slide, I referred to the term unit of accounting, which really is the end of step 2. An entity must start the process by 1, identifying the goods and services promised, which again is the performance obligation. You'll be hearing that a lot. And then determine how many of these performance obligations are separate and distinct. That becomes a unit of accounting and the ability to allocate prices to that unit of accounting. So identifying performance obligations with customers sounds simple, but software companies almost always offer multiple services or goods and services as part of their arrangements. Take a look at this slide, and these are some of the typical offerings that software companies have. The top right being customer service, you've got implementation, you've got upgrades, and so forth as the slide lays out. Now, again, as Mark Ayers mentioned, sometimes goods and services are not specifically documented in the contract, but are nonetheless performed as part of their customary business practices. If the customer has a valid expectation that the vendor will provide a good or service, even if it's not explicitly stated, the entity still must consider those as performance obligations. Now, this slide lays out the 2 criteria needed to be satisfied for a promised good or service to be distinct. And as I mentioned before, that's important because that creates a separate unit of accounting for the allocation of the transaction price. The customer can benefit from a good or service. So these 2 criteria are that the customer can benefit from the good or service either on its own or together with other resources the customer has access to, and it must be separately identifiable from the other promises. So in other words, it must have value and it must have value on its own. So since we recently got done with our holiday season, I thought I'd take this example which is not software related, to show this concept. So take a look at the picture. Now, the race car and its remote are 2 different items sold in one box. The batteries to make them operate are not included. So in this example, how many distinct goods are promised? 0, 1, or 2? In this case, because the customer can buy the batteries from another source, there is 1 distinct performance obligation. There is not 2 units of accounting, i.e. the remote in the car, because the remote and the car are really useless without each other. So they have to be bundled together to be distinct. Now it's time for our first polling question. Data tech company contracts with a customer for a perpetual software license. Installation services, unspecified future customizations, and technical support for 5 years. The installation services include significant customization of the software to interface with the customer data sources. The future customizations and technical support are not critical to maintaining the ongoing utility of the software. So the question is the software license distinct? So, yes, nice job. Actually, the answer is no. I wanted to trick you there. The software license is not distinct from the installation services because the installation services significantly customize the software. So think about this. As such, the software license and the installation services are inputs into a combined output, which is a promise to deliver customized software. Now, to tell you the truth, get used to this because there is so much subjectivity to this standard that you can ask people. There's just going to be a lot of learning curve when it comes to applying the standard. So now I want to stick with this example to point out a very significant change in the old rules versus the new rules. So under the new guidance, qualifying separate units of accounting is easier than it was under the old rules. The new guidance eliminates the The new guidance eliminates the requirement of vendor-specific objective evidence, VSOE, of fair value, to qualify for a separate unit of accounting, and instead replaces it with the concept of distinct promise obligations combined with more acceptable ways to estimate a selling price. Under the old rules, there was a good chance for that example that the revenue for the software license, the revenue for the installation, and the revenue from the unspecified future customizations would have been deferred until all the unspecified future customizations were delivered, which most likely would have been the last year of the contract.
So, Mark, I really like this example. So I think it raises points that people might not consider. So obviously, as Mark mentioned there, when you can't prove the installation, you're deferring until all the customizations are done and delivered. But obviously, as the new recognition relaxes this somewhat and gives different indicators, you could be in the situation where you're applying the new standard and your recognition policy actually means the income doesn't hit the profit and loss or income statement. There's actually just a balance sheet entry and going straight to retained earnings because the recognition is recognized earlier and it's your comparative being adjusted. So it's one to watch. It's not always going to hit your income statement. There could be balance sheet direct items. And I think, Mark, you've got a client that had this exact situation, haven't you?
Yeah, I have a client that has this and spent a lot of time trying to figure out what we could do, but it was this exact situation where they had a 5-year arrangement. The license and installation was completed in year 1. PCS was offered in each of the 5 years. And in our case, the software vendor offered 10,000 hours of unspecified customizations in each of the 5 years. But because the vendor did not have VSOE on the unspecified customizations, none of the revenue had been recorded under the old rules. And now we're in year 4 of this contract, where they're adopting the new rules, and most of it will never be recorded in the income statement because, again, like you said, when you're adopting a new accounting principle, as most people know on this call, you have to restate as if the new principle was done all along, and that's going to create an opening retained earnings adjustment, so the license and all that customization is never going to be recorded in the statement of income, and I think everyone on this call agrees that this is probably the most pervasive change in accounting rules that we've ever seen, because revenue affects so many different industries and so many different companies. So now let's talk about licensing some more. The licensing of intellectual property is an important part of the new revenue standard, not only for software licenses, but for licenses of patents, trademarks, music, and franchises. The new guidance is going to help sift through the complexities of licensing, and obviously in our case, we're interested in the licensing of software. Now, most of the licensing guidance in the new standards revolves around one important concept. You guessed it, to be able to identify performance obligations, but also to help identify when an arrangement is a service rather than a software licensing arrangement. I am, of course, talking about software as a service, or SaaS, which has become the most popular way of selling software. So this picture shows different electronic devices accessing data from the cloud. We're going to talk about this for a minute because it's important because a lot of times software is sold, and this is really what's going on. Now, software as a service may in fact be a hosting arrangement, or in other words, a simple subscription service. This would be the case if the customer cannot take possession of the software and the customer does not have the ability to run the software on its own hardware. If so, then it's a service covered under the other sections of 606 and IFRS, and the revenue should be recognized as the service is provided, no different than a magazine subscription. Many companies, as depicted in this slide, provide hybrid offerings that represent a combination of on-premise software and SaaS. When a license is not distinct from other goods and services, the company will need to combine the performed obligations similar to the race car and the remote. Further, you need to then determine whether the performance obligation is satisfied over time or at a point in time. For example, a software license that solely enables a customer to access content delivered via an online service will probably not be distinct from the online service. So the license would have to be bundled with the online service to qualify as a distinct performance obligation. This would lead to recognizing the revenue over the time the customer has access to the data. So in the scenario in the previous slide, and the one I just described, the entity ends up amortizing the transaction price ratably over time, which makes sense because in both situations, the customer did not end up controlling intellectual property of any value. Now we're going to talk about a few common features with IP licenses: renewals, rights, and cancellations. Software vendors often provide customers the option to renew or extend the term. An option is a separate performance obligation if it provides a material right to the customer that the customer would not be able to receive without entering into the original contract. So what does that mean? The right has to be substantial, not available to others, like a deep discount. We have an example in our revenue recognition podcast of how to account for renewal options, so you can go through that on your own. One thing to note about renewal options, they actually can cause a delay of revenue recognition as compared to the old rules. Under the new rules, revenue allocated to a renewal option can't be recognized until the option term starts, even if the customer has possession of the IP in advance. Now, what about cancellation rights? A cancellation right that allows a customer to cancel a multi-year contract after each year without penalty should be accounted for the same as a one-year contract with a renewal option. So you would go through the same steps to see if it represents a separate performance obligation. Additional copies and allowing for additional users, in general, should be accounted for as additional licenses, and therefore look to see if it creates a separate unit of accounting. Now,
quite an interesting one there again, Mark. Sorry to interject, Mark. Just to raise the point again, where it's going back to what I was talking about on step one, where it's really you're viewing things from the customer perspective. So we're talking about that, the customer's decision to annually continue the contract or not. It's from the customer's perspective, which is a different way of thinking about things than the current standards.
Yes, and this is where I think that all of our clients have to look and spend time and understand their entire customer relationship. And that extends beyond just the software industry. It's a lot of times our clients think about, what is the major parts of a contract and the major parts of the service. But this really requires you to look at some of the ancillary things, and frankly, what that could result in is less of the revenue being recognized up front and more of it being recognized to match it with these other services that, again, like you said, are not laid out in the contract and are not obvious. So that's why everyone really has to spend time and understand what they're giving to the customer. So now, post-contract customer support, obviously PCS accompanies most software arrangements. PCS is generally a separate unit of accounting from the license, even when PCS is not optional, because the software remains functional without the PCS. The only time it may not be distinct is if the updates are critical to the software utility. So now it's time for another polling question. If you remember a few slides ago, we talked about hybrid software license. So what is a hybrid software license? An arrangement that represents a combination of on-premises software and SaaS, a license and an option to add additional features, or an environmentally conscious vehicle. And here we go. Yes. The answer is A, an arrangement that represents a combination of on-premises software and SaaS. And no one was a jokester and answered C. So, good job.
I was pressing the button, Mark, definitely. I wanted 3.
Yeah, that's what I figured. So, that finishes step 2, and now we're on to step 3, determining the transaction price, which is not going to be as long as step 2, I promise you. As I discussed earlier, one of the core principles is to make sure at inception, the entity has considered the entire relationship with a customer, including services that are given downstream in a transaction, which have not previously been allocated part of the purchase, and obviously we just kind of talked about this with Mark. In addition, determining the transaction price is more straightforward when the contract price is fixed, but can be very complex and requires significant judgment when the arrangement includes a variable amount of consideration. This chart lays out how 606 and IFRS 15 view the components of a transaction price. And I think it's a good way to look at it. It's a good summary. And you'll see in the details of it, it has examples of what are some items in the variable consideration, and then, explain the financing component, the consideration paid to customers, which actually occurs more often than you think if you think about discounts and coupons and vouchers, and then things like sales tax or other things collected on behalf of the third party. All of these components need to be considered before a company can allocate consideration to the performance obligations. I'm going to focus on the variable consideration and consideration paid to customers. As per the previous slide, variable consideration can come in many forms. Management must estimate the consideration to which it expects to be entitled to determine the transaction price and to allocate the consideration to the performance obligations. Under the new guidance, variable consideration is only included in the estimated transaction price up to an amount that is probable under US GAAP or highly probable under IFRS, and not resulting in a significant reversal of cumulative revenue in the future. While different terminology is used under IFRS and GAAP, it is intended in this situation to have the same meaning. I'm sorry, IFRS and GAAP. The concept that we're talking about here is called constraining estimates in the new rules. That is the concept of making an estimate conservative and be very, what they don't want you to do, what the service doesn't want you to do is have significant reversals of cumulative revenue. when all the facts and circumstances come out. So for US GAAP purposes, 606 allows two methods to estimate variable consideration. One is the expected value method. It's a probability weighted exercise. And then there's the most likely method. That's the second method, which is a single most likely amount to be received in a range of likely amounts. One thing to note, once you pick a method for a contract, you have to stick with that method through the life of the contract. And I just want to mention that on the Citrin Cooperman website, we have a webinar titled ASC 606, Revenue from Contracts with Customers. This webinar, which is not industry specific, has an exercise showing how to calculate variable consideration. So you can refer to that if you want to get more detail. Now, as expected, the variable consideration needs to be updated at the end of each reporting period, so your facts and circumstances as they change and as the variable consideration could change, that new updated amount has to be allocated to the transaction price, to the performance obligations and reported. That has to be updated every time you have a reporting period. Now, with consideration payable to customers, consideration is often given to customers as incentive to purchase or continue purchasing its goods or services and comes in the form of cash, credits, coupons, and vouchers. Under the new guidance of 606 and IFRS 15, consideration payable is accounted for as a reduction in the transaction price, and if variable, utilizing the same methodology as other variable consideration. So that's it for steps 2 and 3. Now I'm going to go back and turn it over to Mark Ayers.
Thanks, Mark. So this is a good point as to say we've got to. I'm sure we can all count, but we've gone through steps 1, 2, and 3, so some heavy lifting in steps 2 and 3. Now we are into the home stretch, covering steps 4 and 5. So let's kick off with step 4, which is allocating the transaction price to the performance obligation. So the objective for an entity is to allocate the transaction price to each performance obligation in an amount that depicts the amount of consideration the entity expects to be entitled in exchange for transferring the promised goods or services. So the first step is to allocate the transaction price to each performance obligation on a relative standalone selling price basis. So this is the price you would sell a good or service separately to a customer. Discounts and variable consideration are typically allocated to all of the performance obligations based on relative standalone selling prices. If it's not a case of a simple deduction from the consideration to be allocated, consider whether there is evidence that the allocation of discount should be made to only one or perhaps some of the specific elements of the contract. Otherwise, use a proportionate allocation. So your starting point to allocating the transaction price is to review for any relative standalone sales prices. If it's not available, then it should be estimated by considering all information that is reasonably available, maximizing observable inputs. Standalone sales prices are determined at contract inception and not updated to reflect changes between inception and when performance obligation is completed. So this next slide, it lists lots of examples of general market and entity specific factors impacting the estimation of standalone sales prices. I just want to touch on the one in bold writing there, which covers multiple element transactions or bundling. So as we've discussed quite a bit in this seminar, in the software industry, it's commonplace to sell software licenses together with other products and services, for example, consulting, hosting, and ongoing maintenance. So this really brings into question, what is the estimated standalone sales price for each part of this bundle, and how should they be accounted for? And that's really, again, it could be viewed as the customer's estimation of this price from what they've seen on your website elsewhere or other business offerings you provide.
Mark, sorry to chime in. Your list is a really interesting one that you have here, and I totally agree with you that pricing practices as it relates to bundled products is a very relevant one to focus on. When I look at the list, I think there's a couple of other ones that I would just point out as well. Number one, the two items in your left-hand side, the competitor pricing for similar or identical price products, as well as market awareness and perception of the product. I think that what goes into pricing, especially with technology companies, can be whether you're first to market or whether you're introducing a product that might disrupt a market. So your pricing practices become very relevant there in trying to either break into the market or take over the leader there, which is very common with technology. So I think that's another area where this can become very relevant. And obviously, customization on pricing on the other side of your chart becomes also really interesting, because so much of, as Mark Fagan mentioned, so much of the product can become customization and installation and all that goes into the implementation, and understanding and recognizing how your pricing gets impacted by that is going to become very significant to technology companies.
Yeah, thanks, Mike. I completely agree. It's the age-old system of the world we live in now. There's a lot of information out there, and a lot of it is available to you as the provider, and also the customer. So there's a lot of sources to dip from. So a lot of these are extremely relevant to the software industry. So let's move on and start my next slide, which talks about estimating the standalone price. So the new standard does not prescribe or prohibit methods of estimating standalone sales prices. It does, though, require the determined standalone selling price to be a faithful representation, again by applying actual standalone prices or by, again, maximizing observable inputs. So there's 3 examples given by the standard in approaching this estimation task, and these are the adjusted market approach, which is the first example. So this views the market from the perspective of the customer expectation and considers competitors' prices for similar goods or services, adjusting these to reflect the entity's costs and margins. The second example given is the expected cost plus a margin approach, which relies on management estimates and forecasts with an appropriate margin for that good or service applied. And the final approach is like the catch-all. It's the residual approach, which relies on estimating the standalone sales price by reference to total transaction price less the total observable standalone selling prices for identified goods and services. This approach can only be adopted if the entity sells the same good or service to different customers for a broad range of amounts, or secondly, the entity has not yet established a price for that good or service, and the good or service has not previously been sold on a standalone sales price. We again give a great example of applying the principles of step 4 in our webcast series, which you can happily view after this webinar. So now we really are into the final stretch, and this is step 5, which is talking about recognizing revenue. So a company may recognize revenue only when it satisfies a performance obligation by transferring a promised good or service to a customer. A good or service is considered to be transferred when the customer obtains control. It's that customer point again. So a performance obligation is satisfied and revenue recognized when control is transferred to the customer. A customer obtains control if it has the ability to direct the use of and obtain substantially all of the remaining benefits from their good or service. Directing the use of an asset refers to a customer's right to deploy that asset, allow another company to deploy it, or in fact restrict another company from using it. Again, as we mentioned throughout the 5 steps, control should be viewed from a customer perspective. The timing of revenue recognition could change for some companies compared to the current guidance, which is more focused on the transfer of risk and rewards than the transfer of control. The transfer of risk and rewards is still an indicator, though, under the new standard, but companies will need to consider the other additional indicators, which we'll discuss in the coming slides. So let's start with determining when a performance obligation is satisfied. So revenue is recognised as and when control of a promised good or service transfers to the customer. This can be either satisfied over time or satisfied at a point in time. So order is really important here. So first consider whether revenue is satisfied over time. If it's not, then revenue is deemed as satisfied at a point in time. In the next slides, we'll now go through the theory behind the three methods you use for assessing whether revenue is satisfied over time. To be assessed as being satisfied over time, the contract must meet the definition of one or more of the following. A customer receives and simultaneously consumes, or performance creates or enhances an asset which the customer controls, or finally, the asset created has no alternative use and the entity has the enforceable right to payment for completed performance to date. So the first test has been included to assist where application of the first two may be challenging, and examples is where there's high customization of products. Excuse me. So if you fail the assessment of revenue being satisfied over time, you are deemed to have revenue which is settled at a point in time. So there's 5 indicators as to when control is obtained by the customer and therefore revenue should be recognised. These are: there's a right to payment, the customer has legal title, they have physical possession, customer has significant risk and rewards of ownership, and customer has accepted the asset. These are only indications of when the customer may obtain control. As previously mentioned, this could be earlier than the current standard, which refers to the risks and rewards more heavily. So even if you have no other changes from what has been discussed in this webinar, the new standard could still lead to a change in the timing of revenue from review of the 5 points on this slide. Now let's look at an example which demonstrates the different recognition points that could occur. So a software license generally represents a right to use IP for which revenue is recognised at the point in time the control of the license transfers to the customer. Control may transfer when the customer takes possession of the software, either by physical receipt, download, or receipt of an access code or license key to provide the customer the ability to take possession of the software. So the first 2 scenarios on this slide look at the standalone sale of a license, that's for license 1, against the right to use a license for a period, and that's license 2 in this example. The resultant impact on obligations and revenue recognition is as expected, with license 1 being fully satisfied and revenue being recognised at a point in time, against license 2, which has an ongoing obligation and revenue being recognised over time. The third scenario, though, is slightly different, with it's a right to access IP rather than the right to use it. It is again recognised over time, like license 2, but note that the obligation is already settled, which is more akin to license 1. So just to conclude on these 3, so all 3 licenses are provided for a period of 1 year. However, it is what the license gives the customer which determines revenue recognition and not the period of time. So let's move on to our next polling question. So this question is, so Iceberg Co. sells a software license which provides unlimited access to market information on stocks and shares for a fixed term. Iceberg continuously updates this information. Iceberg has determined that the updates are not a separate performance obligation and that the only promise is the grant of the license. Iceberg charges a price of $10,000 per annum for the grant of this license. Should the revenue be recognised at a point in time or over time? So it's excellent. Well, I agree with you. So it's over time. So the majority of you have selected what is the right answer. So let's talk about why. So the customer reasonably expects Iceberg to continuously update the market information. Additionally, the customer's ability to benefit from the license is dependent upon Iceberg's continuous updates. If the market data was not updated, the customer would stop being able to derive a benefit. Although the customer benefits from the continued updates, Iceberg do not transfer an additional good or service to the customer as the update of market information occurs. The grant of a license therefore provides the customer with access to Iceberg's IP as it exists throughout the period. When recognising the revenue, though, Iceberg will need to measure the progress towards the complete satisfaction of performance obligation. The license gives the customer unlimited access over a fixed period. So in this scenario, a time-based method is likely to be the most appropriate measure. So that concludes our whistle-stop tour of the 5 steps. And now I'll hand over to Mike Rhodes, who has what I think is a very difficult task of how to talk you through ideas of how to get started on your transition to the new standard. Over to you, Mike.